Imagine two of the absolute biggest heavyweights on Wall Street looking at the exact same digital asset industry, yet coming to completely opposite conclusions. On one side, you've got BlackRock, literally the world's largest asset manager, throwing its weight behind new legislation to unlock innovation. On the other side, JPMorgan and CEO Jamie Dimon throwing up massive stop signs warning us about shadow banking and systemic risks. Welcome to this explainer, where we're going to unpack this wild divide over the future of digital finance and what it really means for the next era of the internet.
So here's the game plan for today's explainer. We'll look at the Wall Street divide, tackle the uncertainty problem, break down BlackRock's backing of innovation versus JP Morgan's risk warnings, compare innovation and stability, and wrap up with what this all means for founders. Let's get right into it. Section 1. A Wall Street divide, BlackRock versus JP Morgan. This is not just another routine disagreement between two financial giants, guys. This is a fundamental debate about who actually shapes the future of finance. BlackRock is actively backing the Clarity Act, saying clear rules unlock institutional confidence. Meanwhile, Jamie Dimon is strongly opposing parts of it. If you're building a Web3 startup right now, this specific clash could affect absolutely everything, from your fundraising to how you launch a token. But to really understand this divide, we gotta look at the root cause. Section 2. The uncertainty problem, crypto's biggest hurdle. For years now, the real bottleneck for the US crypto industry hasn't actually been the tech itself. You know this. The blockchains work. The cryptography is sound. The real problem? Massive, paralyzing regulatory uncertainty. This brings up the daily reality for builders in this space. Projects are constantly struggling to answer the most basic legal questions. First up, is a token a security? Because if it is, it falls under incredibly strict financial registration laws that, frankly, most startups just cannot afford to navigate. Or, on the flip side, is it a commodity? Treating a digital token like gold or oil completely changes the landscape of how it can be traded, taxed, and used by the public. The fact that the market is still so deeply confused by this classification is just a massive deterrent for institutional money. And finally, the million-dollar question that creates this messy jurisdictional battle: who actually regulates it? The SEC or the CFTC? When the referees can't even agree on who's officiating the game, the players are just left in total chaos. And obviously, this uncertainty is exactly what sparked the massive push for new legislation. Enter the proposed solution. The Clarity Act. This is legislation explicitly designed to establish a clearer framework for digital assets and market oversight. Supporters of this act really believe that drawing clear lines in the sand will dramatically reduce that uncertainty, encourage domestic innovation, and finally make institutions comfortable enough to jump fully into the ecosystem. Which brings us to Section 3. BlackRock backs innovation, the case for clear rules. So why does the world's largest asset manager view this legislation as a massive opportunity instead of a regulatory threat? Well, it comes down to how institutional capital actually operates. Sure, they already have Bitcoin ETFs and are building out digital infrastructure, but managing trillions of dollars requires predictable, boring rules. BlackRock is operating on a very specific, logical playbook here. Step 1. Regulation creates confidence. Big institutions do not like legal gray areas. Step 2. That confidence attracts capital. When the rules are clear, the big money flows in. Step 3. Capital drives adoption across the wider public. And Step 4. That adoption creates larger, much more robust financial markets. For BlackRock, legal clarity is literally the direct pipeline to massive market growth. But, as you might expect, not everyone is looking at that pipeline with rose-colored glasses. Section 4. JP Morgan warns of risks, protecting the financial system. Let's step into the other corner. CEO Jamie Dimon is prioritizing financial stability and expressing some deep public skepticism about how this framework could accidentally destabilize traditional banking. The specific trigger for Dimon's opposition here is yield-bearing stablecoins. These are digital assets that act a whole lot like your traditional savings account. Consumers park their money there to earn a yield. But here is the catch, and it's a big one: they operate under entirely different, and often much lighter, regulatory standards than an actual traditional bank. So the absolutely crucial point here is that JP Morgan isn't necessarily just anti-crypto. They are genuinely concerned about systemic risks. Think about it. If millions of consumers move billions of dollars into products that resemble bank accounts, acting as a sort of shadow banking system, but those products don't follow the equivalent capital requirements and consumer protections, a single failure could be absolutely catastrophic. For them, innovation is important, for sure, but protecting the financial system has to come first. So that leaves us asking in Section 5, innovation versus stability. Who's actually right? If we zoom out impartially from the Clarity Act itself, we're seeing two massive institutions looking at the exact same landscape, but trying to solve two completely different problems. At its core, this is just a fundamental clash of priorities. On one side, BlackRock is asking, how do we bring more investment into digital assets? On the other side, JPMorgan is asking, how do we avoid creating new financial risks? And you know what? Neither of these questions is unreasonable. You need innovation to grow, but you absolutely need stability to survive. If we anchor this debate in history, we actually see a pretty familiar pattern. Back in the early web era, the internet was the innovation, but it eventually required a balance of innovation plus rules to become commercially viable. In digital finance, online banking brought incredible tech, but it demanded strict consumer protections. Now in Web3, crypto is the innovation, and the required rule is, well, still TBD. Will it be the Clarity Act? History shows us that major financial shifts always require a delicate balance of both cutting-edge technology and strict guardrails. Now fast forward to the latest updates as of August 2026. BlackRock, along with a bunch of other major firms, has formally backed the Clarity Act. And while Senate timing and unresolved legislative issues mean the bill's exact future is still pretty unwritten, this represents a massive paradigm shift. Traditional finance is no longer ignoring this technology. The conversation has officially shifted from should crypto even exist to how should it be regulated. Which brings us to our final section, Part 6, what it means for founders, navigating the next phase. If you're tuning into this explainer and you are actively building in Web3, listen up. This policy debate matters so much more than whatever the daily price movements of tokens are doing today. Regulation is going to directly shape investor confidence, your partnerships, and your exchange listings going forward. So here is your actionable survival guide for navigating this new era. As Wall Street gets involved, those Wild West days are fading fast. To survive, you must communicate clearly with your stakeholders. You have to actively build trust. You need to establish undeniable credibility. And you must architect your business to prepare for evolving regulations. These soft skills, they are rapidly becoming your ultimate competitive advantages. Because as we look ahead at this impending collision between traditional finance and decentralized technology, we're left with this really crucial insight from the source material. The biggest advantage may not just be having the best technology, it may be having the strongest reputation. So as BlackRock and JPMorgan battle over the guardrails of digital finance, the real question for you is, how will you adapt your own strategy and reputation as Wall Street reshapes the rules of Web3?
Subscribe and visit Web3 Newswire for visibility and credibility of your Web3 projects.